One of the guys that watches our videos, I asked him what is it that he wanted to kind of see more information on, more content on. And he made mention of underwriting a deal real time. So I appreciate that. The easiest way for anybody to see what we're doing in Bell Capital so I can show you the deals we're underwriting, which I don't have a problem doing, but you got to be a part of our network. It can't just be like on YouTube where I just put out a bunch of information because the deals we look at are owned by companies, institutions, and groups. Some of this stuff we have to sign a CA. Most of the stuff we sign a CA because they're not on the market. They're not on market deals. And these are big institutional quality assets. So I can't just put their financials online. I can give you some insight to the deals, especially if it's a deal that we actually underwrote and we lost that deal and it traded, or we underwrote it, we lost that deal and it didn't trade. So one of the deals we looked at today, I'll just kind of go over this one and I'll go over a couple of things to your point. Thanks for saying that you want to see me do underwriting real time, and I'll share with you what I actually do or how I do it. So this property, um, I'm going to show. Well, first, let me go through a couple of things. This is important because you'll get a better understanding when there's a couple of different ways different people underwrite a deal. When I'm looking at a deal, this is a part of my underwriting because again, with Bell Capital, we are a real estate fund, we raise capital for deals, and it's more to underwriting a deal than just the numbers. That's why some people lose money in a deal, and you got to know this up front. So number one thing I'm looking at I'll just put underwriting a deal. Number one thing I'm looking at, I'll just start right here, is location. This is the number one thing that I care about. Every deal I'm underwriting, I'm always looking at the location, like where is it? Where is it? What's next to it? What's down the street? What are the other properties around it? Like, is it like the deal we looked at today, and I'll go through that property. It's downtown San Diego. I'm not a huge fan of downtown areas because always some giant homeless population. I'm always like, a little too soon. There's great deals down there, but they're great deals, but there's another element that goes along with those deals. So it's like all deals have some element. It's just how hard do you want to work, right? And you can't get rid of those things fast enough. Like that's a city issue. So, but I bring that up to say when I'm underwriting a deal, I'm like, hey, where is it at? If it's downtown, I know there's going to be a homeless situation, there's going to be construction, there's going to be congestion, traffic congestion, or there's going to be a bunch of people walking around. There's going to be crime, there's going to be pee, there's going to be poo on the street, depending on where you're at, right? If you're downtown LA or you're downtown San Diego, there's something going on in every one of those. But there's also great things happening down there. There's the art district. There's a gas lamp district. There's Little Italy. There's the harbor. There's all the different things that are going on that the city is trying to do because I believe downtown San Diego, the city of San Diego, is the next Miami. That's the location is more important than the asset, is more important than the price, is more important than anything. Which brings me to the next thing that I'm underwriting, which is the urgent seller, the group, right? So like one of the deals we looked at, it was owned by a bank, a Wall Street bank. If I said the name, you know who they are. They sold a portfolio of assets, same location as the other one. The other one was one of the largest apartment building owners in the world. I can say them. It was EQR, it was Equity Residential, which was Sam Zell's company. Like when you start seeing deals like that trade, when I'm talking to a broker, my first question is like, hey, why are they coming to market right now? Are they sellers? Who's the seller? Is it the debt or is it the owner? Like who's forcing the sale here? The debt or the equity? And then they'll let me know. Or like for us, my model inside of Bell Capital for what we're doing, like my investment thesis is to go after properties that the seller has some urgency based on the debt coming due. Maybe they're in a fund like ours where their time is up, or a syndicator, or maybe they bought an asset from a developer. They're the first owner, meaning like the developer owned it to sell it, right? And then once the developer built it, they sold it to the next owner, and that next owner became the first operator. And then they've operated it up to where they wanted to, and they've hit their timeline. And now they have to transition out because of maybe their debt. Maybe they got 3 year debt. Maybe they got 5 year debt. Maybe their equity partners were in a 3 year hold and they wanted their returns. And their equity partner is CalPERS, like the California Pension Fund, or the Fire Department Pension Fund, or the state of Pennsylvania, or the state of Florida, whatever, right? And they need their money back. And they were like, hey, we're supposed to be in this deal for 5 years. You've had it for 5 years. You had the extension last year. and now we need our capital. Like those are reasons why a owner or an insurance company or a group or an institution would want an exit a deal. Or maybe their balance sheet, maybe they have a sheet full, like, because that's who has these assets. They're not, some of these groups have 80,000 units or 100,000 units or whatever. Like, they have hundreds of properties on a spreadsheet and they're saying, look, we have 50 assets that we have 50 assets that are performing really well, and we have 20 that are not. So when you are a company like that, so you guys get it, and I'm going through this as it relates to underwriting and urgency. You sell your good assets to cover the losses of the bad ones. You can't sell the bad ones at a loss. You got to sell the good ones, take your capital, make your capital, and replenish from the other side. So that's why when I'm asking a broker, like, hey, who's the seller? Is it the debt that's forcing the sale, the equity partners, or did they just come to the end of their fund or their whatever it is that their timeline is, and time is up and they got to go? Like that's the other form of due diligence or underwriting that I do. So number one, I'm looking at location. Number two, what is the seller's urgency? Why are they exiting this deal? Because now is never the right time with the rates in flux the way that they are. The next thing I'm looking at is risk. Sorry, my phone was going off. What is the risk? So when I'm taking a look at a deal, like it's like you guys have heard me say all the time, like don't lose money. Like, can the location cause a risk, right? Is there urgency in a situation where it's going to, whereas we start to underwrite the deal, we don't have time to make adjustments because they don't have time. Like, or maybe like in the path of progress, or let's say, because we looked at a deal a little while ago, and this property, great location, great property, and across the way, they're already clearing the lot to build up like another 300 unit apartment complex. There's a risk there. We could lose money at that location, even though that property was a great property and it was 10 years old. It was a little less than 10 years old. A brand new asset coming online, meaning like coming to market, will warrant new people. So the people that live in that property we were underwriting, they're probably going to move to the new one. So there is going to be some loss there, and that's a risk, right? Can we mitigate the risk? Could we say, hey, what's the risk here? Could we lose money in 10 years? Could they block this road off? Is there some big development plan going on where the Department of Transportation, DOT, is going to block off entrance so you got to drive down to the next exit, then bust a U and come back out the light? That sucks, dude. That's risky. So when we're looking at a deal, it's not just price and the property underwriting. There's so much more underwriting that goes on when you're playing on the capital side. See, I'm not an operator. I'm not a property management company. I don't do all that stuff. We have third-party property management. I'm a capital allocator. We raise capital and we manage the asset itself, while the property is being managed by a property management company. So my job is to not lose my investors' money. Number one, don't lose money. Number two, don't lose money. So when I'm saying these things for you guys, when I'm underwriting a deal, like my guy that asked me, like, hey, could you underwrite a deal real time? I'm going to go through that, but for the most part, this is some real time underwriting that I look at. So number one, that thing is don't risk it. Don't risk it for the biscuit, man. Like the biscuit sometimes ain't going to be that big, and you need to know that before you get into a deal that you can't get out of. If you get into a 150, 200 unit deal, if you get in a 40 unit deal, it's not like a stock where you could just press a button today and it's gone. Like you have to prepare the property. Even exiting a deal. I may do a deal. I think I've done a video on exiting a property. Exiting a property, selling it is the same as refinancing a property by going back to the lender. You still prepare it the exact same way. So if the property has risk, you have to get out of it because it's a real asset. You can't just like sell it. You got to come to market. It may take 30, 60, 90 days just for exposure and another 45 days to close. You may be in that deal for 6 to 8 months, depending on the size of the deal and the market you're in. That's why all of these things matter. And then I worry about price. Price, this one is probably the least important to me. It's important. Everyone says it's not important, but it is important because I'll be honest with you, I want to steal stuff, but sometimes stealing property is getting a property that would have never come to market. If there's a property that they only trade it, that let's say it's called a net buyer versus a net seller. Some companies like True America, they're net buyers. They rarely ever sell their assets. Or Cortland, they're net buyers. They rarely ever sell. And also some of these other like REITs, they like Essex, they very rarely ever sell. If they sell at all, It's because that property has now become obsolete in their portfolio and they'll come to market. So that's the only time. But then I'm looking at urgency. Wow, why are they coming to market? Oh, it's timed out. It doesn't fit their portfolio anymore. Maybe it's a 90s product and all of the properties they own are like 23, 2020, whatever. And it was this one's from 1998. So they're exiting the deals. So then I'm like, okay, what's the risk? What's going on? Why they choose this one? Tell me. I think this is a great location. What the great location? What made them choose this other than just them needing to get rid of it because now is not the right time? Why are they looking to do this? And what's the price expectation? What if they don't get it? So they still have the urgency, the risk is still there, but what if they don't get their price? What are they going to do? Are they going to refinance it? Are they going to bring in new investors? Are they just going to recycle this asset inside of their portfolio and come to market later? This happens all the time. That's why price is the least important. But I do want to steal stuff. And if I can get a deal that I'll never get, that's stealing, even if I pay full price or more. Or I'm going to rip your head off at closing as long as I can get it what below replacement cost, BRC, below replacement cost, what it costs to build it, and below purchase price. Like let's say they bought it for 200,000 a door, a 200 unit property for 200,000 a door, unheard of, for 40 million, whatever. And I can go back, let's say it's a great property, great asset, great location, and I can buy for below what they paid for it or for what they paid for it today, and they owned it for 5 years or 3 years or 7 years, and it would cost 900,000 to build it, but I'm still getting it for 200,000. And today's pricing for trading is 400,000. I don't know, like just stick with me on that. This makes the price me stealing. This is below replacement cost stealing, below purchase price when they bought it, not when I'm buying it, is also stealing. That's winning the deal. But you got to know that. You don't know that unless you involve all of the aspects of your underwriting in a deal. Don't think about you as just buying a property if you're going to underwrite a deal. Think about yourself as a bank. I look at myself like an institution. This is what institutions do. Don't lose money. These are all the different ways you underwrite an actual deal without underwriting the deal, right? And then last but not least, this one deserves its own page. Hold on. This one deserves its own page. Last but not least, can I? This is the money question. Now we start thinking like the bank. So can I get at least 5% cash on my money for my investors? Right? Can we hit that target? That's a target. I always want that as a target, right? At some point, the average return on our money needs to be somewhere around 5% with the benefits of real estate. And number two, could we get equity multiple? Boom, here. Could we do a 2x equity multiple or MOIC? A multiple on invested capital, right? But just stick to equity multiple. That one's too confusing. Banks use this one, pension funds, all the other stuff. But equity multiple, two times our money. So if we invested $20 million, we want to make sure we get 20 million turns into 40 million at the end of that deal. Can this happen? Is there any way possible that we can't generate 5% return on our money at a minimum? And the reason why 5% makes sense to me is because if you were to get Treasury right now, Treasury, if you were to buy a bond or Treasury bill or something, that's at like 4.1 or 4.0 or whatever it is today. I didn't check today, but I want to be able to get that. Now, in real estate, because of the tax benefits, I may be able to get that tax with a 5% cash on cash return on my money. That may be tax benefited. I may not have to pay taxes on that. So let's say at 5%, if I got 5% return on my money in something that didn't have the tax benefits, I'm gonna have to pay, let's just say I'm a big shot and I pay 40% taxes on my earned income or whatever, right? Ordinary income, that's what that return would be. Now I would lose 40% of the five. So technically that's like getting 2% on my money or two and a half. But if I got 5% on my money and I got the tax benefits of real estate passed on to me with that cash flow, that's like getting 7% because now it's not costing me the 2% or the two and a half that would have cost if I got the five. So a little bit confusing, but that's what I think about. I'm like, hey, could we get our investors 5% return or more on their money at any point? That's my goal. That's a target. And then next, do I think we can double our money at the end of this deal? At the end of this deal, do I think I can sell and double my investors' money and we all make a bunch of money and we waited and got paid to wait through cash flow for that deal? So when I'm underwriting a deal, I'm always looking at that. Right? This 5%, that could be a 15% internal rate of return. IRR, which is IRR is a fancy word for internal rate of return. That just means at the end of the that end of the deal, cash flow and appreciation over time, I've made 15% year over year on my money, right? For the whole period. So these are the things that I'm looking at when I'm underwriting a deal. While it's not an actual deal per se, it doesn't matter. This could be a 10 unit, it could be a 20 unit, it could be a 200 unit, whatever, it doesn't matter. I'm looking at the location, urgency of the seller. Let's say it's a mom and pop. Let's say it's a dentist. He's older. He's been pulling people's teeth out. He's ready to retire. His kids don't want it. And I'm like, hey, what's the reason for selling? Why do you want to come to market? What's going on? Then I'm gonna be like, hey, what's the risk here? Could this thing not do what it's supposed to be doing? What if it only does what it does now? Do I still want this deal in my portfolio? Will my investors want this deal? Do we think there's a risk here? Could they shut the road down? Could they shut this area down? Is crime moving in or is it moving out of this area? Are good schools here? Are people losing jobs? Is the market crushing? Like what's happening? And then next, I'm like, hey, what's the price? What's the price expectation? What's the guidance on the price? Would you tell me what is expected of this price? Or what is the, like a broker's use what's called a BOV, a broker opinion of value? And then you ask, like, hey, what is your BOV? Or what is the seller's pricing expectation? Or what's the guidance on this property? Guidance is kind of a, California thing, West Coast thing, but on the East Coast, they'll say, hey, what's the price expectation? So those are the two different terms that you would ask a broker. And like I said, last but not least, what I'm looking at are my target returns. This is the money. Can we make money in this deal? And the other piece, will we lose money in this deal? Like I say, I already didn't want over risk. I go over risk first. So right away, I'm like, hey, could we get 5%? If this is our target, what is that going to take? Is it already making it? Yes. And then can we continue to make it over time towards when we exit the deal? Let's say we're in it for 7 years or 10 years. Are we going to hit a minimum 15% internal rate of return? That could be a net, that could be a gross. That could be 15% internal rate of return or anywhere from 13 to 15% internal rate of return to my investors. And the rest of it comes to me because in my deals, we do an 80-20 split. The investors get 80% of the upside. I get 20% of the 20% of it. If I do a good job, we make a ton of money together. That's my goal. So you're asking about the underwriting. This is how I do it, whether it was a deal or not. Because I can do that. We can do that later. I'll do that on a different video because this one went a little long. But I wanted to go over that because the other piece is just figuring out like income minus expenses leads to your NOI or your net operating income. That's how you underwrite the deal. But if you can't do this part, you'll never get to the NOI stuff, right? Because if none of this matters, then I don't want to even look. Like I don't care because if it don't hit some of these underwriting pieces, because I go to every property. I drive the property, I walk the property, I talk to the brokers. Like you have to do this deal. If you aren't willing to go to the properties, talk to the property managers, connect with the tenants, walk with the brokers, the debt brokers, the guys who's going to bring the financing, like we said in other videos, your debt person, whoever's doing the financing and the loans, that's your biggest partner, your lender. So you need to talk to them. You need to meet up with them. You need to find out what they like about the property, as well as a property management office or company who's going to be managing the property. You need to talk to them as well and find out, like, what do you guys think about this deal? Do you guys like the deal? Did you manage a deal like it? Are you managing other assets in the same neighborhood so you have some insider information that you can help us understand whether we're going to get $50 rent bump, $75 rent bump, $100, $200, $500. What do you think the rents are going to be in 10 years? Like all of that matters as it relates to one, can we lose, are we going to lose money? And number two, are we going to be able to hit our return targets for our investors? Like all of that's a part of the underwriting. Even before you see a deal, you need to see a deal. You need to see this in your mind. So I hope this helps with these pieces of underwriting. There's five pieces. Like I said, there's your location, your urgency, risk, price, and can we hit our investment targets on this specific asset? If we can't do that, it's a pass. But you got to be able to, number one, you got to get there, see the deal. If you aren't going to do that, don't get in this business. I'm just going to tell you, don't dabble in this business. This is big boy, big girl world, and you can make a lot of money here. You can make millions of dollars here, or this shit can sink your battleship and you be bankrupt. I've been there. I had to start over because I bought the wrong deal, and I'm telling you, these are the lessons that I've learned, and I will not break my own rules again. All right. So I hope that helps. I really do. This went a little longer than I thought, but I know this is going to help you. So if you think about underwriting a deal, don't just think about the numbers. AI can eliminate your lack of ability to underwrite the numbers of a deal. You just take a portfolio or take the spreadsheets, dump them in AI, and you ask them, hey, what do you think this deal's worth? But you got to know this because AI is not going to tour the property for you. It's not going to drive and walk the property. You're not going to be able to see the neighborhood, see the people walking around, see whether it's a place where people want to live and be because your asset, the asset you're investing in, people live there. It is not it's not AI. It's not a stock. It's real. And you want to be able to do real things. And you have to have an eye for that. So I said, most people shouldn't do this business. They should just invest with a guy like me who's more committed than they are. And they should stick to operating and running their business and making money and just invest passively in a deal with somebody who's serious. All right. So, but if that's not you and you want to do it yourself, by all means, do it. We're here for you. If you want to invest with us, you want more information, go to bell-capital.com and you can do two things there. You can hit schedule a call, talk to someone on my team about potentially investing as ask questions, or you can hit get started or invest now or something. And then you can go to our investor portal, register your free account. You can get access to our deals, the fund, how things work. You can get direct access to myself or someone on my team. You can see the deals we're looking at, underwriting. We'll share that information with you once you're in our world. You sit at the table with us. Whether you invest or not, doesn't matter. I want to help you. All right. So like this video, share the video, comment on this video. We're here for you. Give it a thumbs up or give it a thumbs down. Don't be a hater and a hider at the same time. Either way, we're here. All right, man. Have a great day today. Appreciate you. Let's get after it. Boom.